Well, it's that time of the month again. That's when I have my regular Big Picture podcast with Pete Wargent as we look at the macroeconomic factors affecting our economy and our property markets. Now, this time last year, we were supposed to have a federal budget. Instead, we had a pandemic. And over the year, many elements of our life were upended due to COVID-19. Around this time last year also, I remember Prime Minister Scott Morrison said he was going to build a bridge for us to get us across to the other side. And it seems he did. Of course, in between, the government threw everything it could, including billions of dollars at creating jobs, keeping our economy moving, and it succeeded. And it's still going to be spending money. If you look at the budget recently handed down by Treasurer Josh Frydenberg, you'd also think it was raining money, still raining money. Never before has a budget done so much to supercharge the economy after the worst of the recession has passed. But don't worry, this isn't another podcast where we're going to rehash the budget, even though there's a few interesting points that I want to discuss with Pete, things that weren't clearly explained. But I think it's really important to understand the macroeconomic factors affecting our economy and our property markets, because when Pete and I do that, I hope it'll give you some clarity about what the future holds so you can make better investment and better business decisions. So welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Property markets don't operate in isolation, so I believe it's good to regularly have a look at the big picture, the macroeconomic factors affecting not just Australia's economy, but the world economy. And who better to discuss this with than Pete Wargent, a lifelong student and commentator of our economy. Hello, Pete.
Hi, Michael.
Well, since we spoke last month, there's been a lot of good economic news, and Josh Frydenberg's delivered his budget this year. And the underlying message I got from his pandemic budget is that while our recovery is running apace, the economy still remains fragile. It's unable to stand on its own 2 feet, and the government really had no option but to continue spending. It's given the green light to a number of initiatives to ensure our economy continues to recover. And with all the tax dollars rolling in, what kind of treasurer could actually resist all this spending, given the ultra-cheap cost of borrowing? And maybe I should be a little bit cynical. Maybe there's an election coming up in the next year or so. So from what I saw, booming iron ore exports delivered a bumper company tax rate over March. The budget's bottom line was better than anticipated. And it looks like our economic recovery is going to continue, underpinned by strong household spending, supported by lifting restrictions and activities. We're getting back to more normal life, increased confidence in general in our economy and our jobs. So with almost everyone seeming a winner in this year's budget, Pete, what are some of the property-related initiatives that you've had a chance to look at, and what's your thought about the budget?
Yeah, interesting one. So since we spoke a month ago, it's just been an endless stream of good news. So you've mentioned some of the things that have happened, but particularly commodities. The iron ore price is at, $238 this morning. I mean, we've seen previous budgets that have assumed iron ore would be around about $55 a tonne. I mean, this is just an enormous windfall for Australia, but almost everything else has been strong as well, essentially because the government put in this $300 billion stimulus package, and as things have transpired, COVID just wasn't as big a threat in Australia as we feared. So all of those dollars are essentially trapped at home. People can't travel internationally, and the economy is really firing back. So in terms of the budget itself, as you said, the budget balance is going to be a heck of a lot better over the next 4 years than we thought it would, probably about 100 billion or so. But that's still a very stimulatory setting. $100 billion deficit. That's a huge amount of money that's coming into the economy effectively. The property-specific measures, I think there was a few in there. The family home guarantee for single parents. There was an extension to the super withdrawal scheme, and also the extension of the first home loan deposit scheme for first home buyers with 5% deposit. So I think my reading of that is a lot of those measures are designed to stimulate demand, but particularly towards the units and apartments parts of the economy, which has been hit because of the lack of international students and tourists. So because of the price and income caps, that'll basically support the lower end of the market, especially in Sydney and Melbourne. So yeah, there's lots of good news coming for the economy, and property will probably go from strength to strength. I think the only real clouds on the horizon, election year always slows things down a bit, and maybe APRA might just step in next year if things overheat.
One of the other bits in the budget that I found interesting was the incentive for downsizers to sell up their homes and move to other accommodation. Australians aged over the age of 60 who downsize their family home have been rewarded by being able to contribute $300,000 a person or $600,000 into the superannuation. Now, this was already there, but it was a sort of underwhelming system. Pete, I don't know how well it worked. Are you going to, as a downsizer, sell up? Where are you going to move to? Because if you want to move to a family-friendly apartment, not a little pokey one, and in the same location, or if you're going to want to move to a townhouse, you're not going to have much change left over. So I recently read that the suggestion was a huge number of baby boomers are going to downsize because of this. I can't see that happening.
Yeah, that's clearly the intention of the policy, is because baby boomers, as we know, have built up large pools of equity. And I guess the idea is let's get a few of them to sell and redeploy some of that cash into the economy rather than sitting on it as equity. I mean, there has been a lot of downsizing over the years, but it's probably not in the same numbers as people thought years ago. And Australia is a little bit different from other nations because our population pyramid is very, very strong in that 25 to 35 age bracket. There's much more people in that end of the market coming in as first-time buyers, so that kind of overwhelms any baby boomer influence from selling. Quite different from other countries like Japan or lots of parts of Europe. Australia has had a very high level of immigration, so of course that's very bullish for housing because there's just a wave of first-time buyers coming in.
Well, you're right. In the past, it used to be the baby boomers who led the trends into initially needing more schools and needing more universities and maybe now in the long term, maybe needing more nursing homes. But during those formative years, family years, all the new suburbs were built to house the baby boomers. It's the millennials now who are moving out of the city apartments, coming to family formation age.
Yes, and I mean, first-time buyer numbers are near record levels. That's partly to do with the government stimulus that's been in place, the first home loan deposit scheme, but also the dynamics have just really shifted in favour of buying over renting. Rents are now rising around the country. Interest rates are at record lows, and there's the availability to buy with a 5% deposit. So we've seen no end of first-time buyers who've been sitting on the fence finally taking the plunge this year, and that's been great to see. I think it's good to see new entrants getting on the housing ladder and starting to build a life for themselves.
Well, looking at other economic news over the last month, there's been a rapid fall in unemployment. More jobs are being created. It's actually now being forecast that unemployment could fall to below 5% by the end of this year and in the middle of 4% unemployment by 2022, which is actually where the Reserve Bank has been saying they want to get unemployment because they're looking for wages to go up. Pete, do you think this is going to challenge the Reserve Bank's expectation of a rate hike? They said it's unlikely for rates to go up till 2024 at the earliest, but if unemployment drops, would it bring this forward?
It could, yeah. I think it's funny how things work out, you know. Since 2014, we've had this really strange tug of war between the Reserve Bank running monetary policy and trying not to overstimulate the housing market, so keeping policy probably tighter than it should have been, and the government trying to balance the books. There's been this sort of fetish for a surplus in Australia and being very careful in terms of budget management. But then COVID came along and everything just got blown out of the water. So the Reserve Bank cut interest rates to effectively zero. They pushed down interest rates even for 3-year bond yields, and also quantitative easing to push down rates. So, and now the government, we've seen all these budgets in recent years where $1 billion here or $1 billion there. There's lots of contentious points. Well, now when you're running a deficit of 100 billion, well, to a certain degree, who cares? Just splash the cash. So for the first time in a long time, we've got monetary policy and fiscal policy both working together. So I think we will see unemployment falling very quickly now. I guess what the Reserve Bank wants to see is an unemployment rate much closer to 4%, because that will push wages up. So I don't know how quickly that happens, and we'll have to wait and see. But if unemployment falls to 4%, then yeah, maybe it is time for rates to begin normalizing. But I think it will happen slowly in every situation.
Well, we're also in the world economy, so therefore our rates can't be that much out of kilter to overseas economies. But the other thing that's in the back of the mind of the RBA, of course, is inflation. So it's not just wages or unemployment they're fussed about. They're wanting to keep inflation a little bit higher than it's been. But there's been sluggish numbers recently. The inflation didn't really push up very high in the last set of statistics, did it?
Not at all in Australia. In fact, it was a big miss for the March quarter. So annual inflation was only just above 1%. And in fact, the core measures that the Reserve Bank prefers to look at are at the lowest level in history. So it's really, we're a long way from the 2 to 3% band. I think, though, there are signs of inflation. So, for example, we're starting to see rents rising now. I'm pretty sure we'll see building materials. There'll be some inflation there. And in fact, just at the time of speaking, we've just got the April figures out from the US, and suddenly inflation has come roaring back 4%, more than 4%, 4.2% over the year to April, and the core measure at 3%. So those are the highest figures we've seen since 2008. Now, I suppose the big question is that inflation coming back permanently, or is it just a transitory spike? I think if you look at what 10-year break-even rates are saying, so not to get too technical, but if you look at what financial markets are expecting, they think this is a one-off and it will probably go away again. So I think with inflation at record lows in Australia, clearly interest rate hikes are a long way off, but it'll just be an interesting story to watch over the next year or two. Does inflation come back? And if so, does it actually stick?
Well, to some of us who remember the CPI being above 10% for much of the 70s and 80s, I remember that. And I remember the Reserve Bank at that stage was determined to drive down inflation. Some people may think, hey, this is counterintuitive. So what's the RBA all fussed about? Why does it want to get inflation between 2 and 3%?
Well, it's part of the Reserve Bank's mandate is to keep inflation on average between 2 and 3% through the cycle. Now, since 2014, we've been under the target. So I suppose unless it's an asymmetric target, really, inflation, they should be running it quite a lot warmer or hotter than it has been for 6 or 7 years now. So the mandate tries to keep a level of stability there, and 2 to 3% is the target. And we haven't been near that for a long time. So they would like to see more inflation, but we'll have to wait and see whether these rents and some of the inflation in the building sector, is it going to stick around for the next few years, or is it going to ebb away again?
Well, one question would be, is it still relevant to try and get it between 2 and 3%? With regard to construction, we actually know that that was not a driver of inflation over the last little while, but we're seeing on the ground in our construction company a tightening of supply. It's actually hard to get materials, and definitely a shortage of labour where tradespeople can choose as many jobs as they want at the moment. So I can see construction costs being one of the things that's going to go up, and rents are starting to creep up a little bit at the moment, aren't they?
Yeah, and in fact, there will be labour shortages. There are already shortages in some sectors of the economy, but at the moment, it's the lower paid jobs, because we don't have people coming in on temporary work visas, working holiday visas, international students. They're just not coming. So at the moment, there is inflation there in pay, but it's down at the lower end of the market, and we're not seeing it in the numbers. But it will start to happen. I think if the international borders stay shut till the middle of 2022, another year of stimulus, well, yeah, I think we will start to see wages begin to rise again. But that's good, because we've had record low wages growth over the past year, and we want to see it at 3 to 4%. So I think it'll be good to see incomes going up again, and not just from government stimulus, but from actual wage packets.
Sure. I mean, if you think about it, there are people who still haven't got a job. The airline pilots can't fly, but they're not going to suddenly go and work on building sites and pick up a shovel or a pick because, in fact, they're not qualified or licensed to do it, and I can't see that happening. So there's a disparity. There is a few people unemployed in certain segments, and that's not going to come around too quickly, but there's a shortage of various skilled labour, which in the past, we actually had that beautiful ability to just change the rules and get them in from overseas. That's disappeared.
Yeah, I mean, I guess that was the downside to running population growth. At one stage, it was, 450,000 per annum. So when you've got that many people coming into the labour force, effectively growing the population at, say, 2%, well, that's a lot of extra labour that comes in every year. This is a change from that. So there's good and bad parts to it. And some people would say, well, this is probably a good thing if it pushes down the unemployment rate. But we will start to see skill shortages in time. And I think there's already plans afoot to start bringing back international students. And I suspect maybe some more travel bubbles will begin to open up. Already got one with New Zealand. I just wonder whether Singapore or maybe somewhere else gets added to the list over time.
Well, I know Pam and I are looking forward to that. Pete, one of the interesting things is that the current housing boom has upset some people. You can't please everybody, but the doomsayers are there out on the internet again. Well, not again, they've been there the whole time. And, the ones who predicted the property market was going to crash last year, now they're suggesting our booming property markets are precipitating unacceptable inequality. It's not fair that the rich are getting richer. Now, I know we've spoken before that we see a social issue with the big difference between the wealthy and the poor. But I was interested to hear the Deputy Governor of the Reserve Bank, Guy Debelle, he delivered some important home truths a couple of weeks ago. He asked, would you rather that much higher unemployment and far greater income inequality would result in millions of Australians on the dole? He stressed that cheaper money, expanded purchasing power, rising asset prices, additional construction, higher household income, consumption, employment, confidence and wealth, they were all essential elements of the Reserve Bank's stimulus. So what he was saying was higher housing prices may not have grown as quickly as money, but unemployment would have definitely ended up creating even more disparity between the rich and the poor, because it's only certain people in Australia who have suffered from COVID.
There will always be distributional consequences, as Debelle said, because ultimately the Reserve Bank has only got a blunt tool, being the change in interest rates. There's not a whole lot more they can do. They can do bits and pieces with foreign exchange and so on, but ultimately they've only got a blunt tool to manage demand in the economy. So, and this can be your advantage as a property market participant, because policymakers can make changes at the macro level, but they've got very little influence in some ways down at the micro level. So if you can identify some of the trends that are happening and get in front of them, then you can do very well as a property market participant. I think there was an old saying decades and decades ago, we'll find out where the people are moving to and buy the land before they get there. And it hasn't really changed, to be honest. The changes this year have been not as many people in those big high-rise towers in the city, and people have been moving out to the suburbs and moving out, in some cases, to the coastal markets. Well, that those markets have done very well, while those high-rise towers in the CBDs have struggled.
Sure. I guess if you look at it at a higher level, a macro level, even though our population probably won't reach 30 million people at the end of this decade by 2030, like the forecast had suggested, it may reach 29 million people. So there's still another 3.5 million people going to come to Australia over the next 7-8 years. And if you get in the property markets now, you're going to be ahead of those 3.5 million other people. So, of course, you've got to choose where they want to go, the sort of properties they're going to want to live in. So that's the topic of another podcast. But interestingly, investors are back in the market as well now. Home loan approvals have been surging, and we know for most of this year it's been first homeowners and also people renovating their home. There's been a large number of loans for people to just stay put but improve. But investors seem to be back if you take into account the increasing investor loan approvals, Pete.
Yeah, so I think the April figures showed investor lending spiked higher, got back to 7.8 billion. But for context, in 2015, investor lending got above 10 billion. So there's a long way to go. Plus, interest rates are much lower today, and incomes are substantially higher over the past 6 years. So, I mean, I could see investor lending doubling from here. I think, I mean, you guys at Metropole would know this. The lending indicators that are reported by the ABS, that's all rear view mirror stuff. Quite often, you're getting those inquiries in January and February, and it's only now just starting to show up in the figures. But we knew this was coming just by the level of inquiry that you would have seen in your offices and the investors getting ready to buy. I think that's got a long way to run. On your point on immigration, of course, at the moment, people are saying, well, yes, immigration's effectively switched off. But investors, they tend to be in the market for the long haul. And don't forget, when the borders do reopen, well, just like when the economy's reopened in Melbourne and elsewhere, the pent-up demand for living in Australia is going to be, unprecedented, I would think, because Australia's always been a popular and clean, safe and wealthy country. Well, now you've got, it's a COVID-safe country as well. So reputation just goes from strength to strength. And no doubt it's going to be a bumper reopening in 2022 or as and when it happens.
Oh, I'm sure that people are going to want to flock here from overseas. So I know Melbourne has been the poor cousin, Melbourne, where I live, where people interstate have been making fun of the 800 cases, 900 unfortunate deaths from COVID. But when people from outside Australia look at us, Melbourne's the only city of 5 million people that's actually beaten COVID, and life's moved on again. So, yeah, I think we're seen very, very favourably overseas. Looking at the statistics that have come back over the last month since our last monthly chat about this, another one was a continuation of the building approvals. They're now the second highest in history in March. It was a huge upside. And in general, though, I'm sure some of this was due to Home Builder, which was introduced, that's now being phased out. But there seems to be a much bigger influence on building of separate dwellings as opposed to apartments. So that's one of the things that means that all those empty apartment houses are slowly going to get soaked up, because it takes a long time to build apartments, to get them through the planning stage, to get them sold, to get them pre-sold so that they can get the finance. It'll be a long time before new cranes turn up on our cities.
Yeah, for sure. So you're right. The home builder has really driven a surge in detached dwelling approvals. So especially in cities like Perth, where nothing's really been built for 6 years, and suddenly it's absolutely booming. So house approvals are at record highs, and houses tend to get built quite quickly. In 6 to 9 months, you'll see that supply hitting the market. But again, a lot of the analysis is very oversimplified, and people say, oh, look, we're building these houses, there'll be an oversupply. I think they've got that dead wrong, though. Rental vacancies are now the tightest we've seen in a decade. And in fact, rents are going vertical in a lot of areas. If you look at Gold Coast or Noosa, no doubt some of the coastal markets like Mornington, all around the country, really, because what we've seen is household sizes have just fallen. And this is, some of the unexpected outcomes from a pandemic. People stop living in house shares, and they split off into smaller groups, and it's putting tremendous pressure on housing. I don't think some of the high-level analysis really captures that. And as you said, unit approvals are at very low levels compared to where they were now. And in fact, vacancies are even falling in the CBD. So, I don't think oversupply is really an issue. Because we actually need more detached houses, and that's a good thing.
Well, those detached houses are already pre-committed to owner-occupier, so there's not going to be an oversupply. I read the same sort of things and thought, what are you talking about? I'd like to finish off with something maybe a little bit different, and something that I know a number of us are worried about, the geopolitical risks in the world. Now, earlier on, we talked about the fact that iron ore prices have gone up, and somebody who I know you and I both respect and follow, Christopher Joy from Coolabah Capital, wrote an interesting tweet a little while ago saying that a while ago he mentioned that maybe some overseas countries stockpiling iron ore. If you're going to war in sometime in the future, and you need steel for guns, for tanks, for submarines, for planes, maybe if you're that country, you'd be buying up as much iron ore as you can. That was a scary thought, Pete.
I think this was happening before the pandemic, but there's certainly more geopolitical tensions. I think we've had a huge trend of globalization over recent decades, and that's now fracturing quite a lot. I mean, we saw this in Europe with Britain leaving the European Union, but that's only a minor thing on a global scale. The bigger issues are what happens between the US and China. There was issues on the Russia and Ukraine border. There's a lot of stuff happening in the world that is tense. I think the big thing for Australia is what happens with our relationship with China, because a lot of our migrants have come from China, certainly international students. We had record high tourism from China. And for a long time, Chinese buyers were buying most of our new property, but that seems to have cooled as well. So iron ore trade is going very well, but the other issues between China and Australia, that remains to be seen. So we might have a different dynamic there going forward. I think just generally, there's been a general political shift over the past year or two with people now looking towards governments to create jobs. I think that wasn't such a big feature of recent times, but now people are saying, well, hang on a second, you've closed down half of the world's economies. It's down to the government to create jobs. So that's a shift to the left, effectively, which we hadn't seen in recent years.
Sure. So there's always geopolitical risks. I'm old enough to remember the Cold War in America and Russia, all the Middle East tensions. Australia's gone to lots of wars supporting our allies, including one in Afghanistan, Vietnam. But hopefully we're going to be able to avoid a war over Taiwan. I mean, that's one of the thoughts in people's mind, that if China invades Taiwan and America supports Taiwan, what's Australia going to do? I don't think China particularly wants to invade Australia, but we may be at war in other ways. There's all the talk about the internet wars and the way that they're getting our information and gathering information on us.
Yeah, certainly tensions, and we've already seen some of that. Whether there's the appetite for an escalation, we'll have to wait and see. And, we've had a change of president in the US, so that might change things a little bit. There was certainly some tension there under the Trump administration. So, yeah, but those things are always present. We just have to wait and see how things play out. But certainly domestically, Australia is, with effectively the fastest growing developed economy that's out there. So things have played out far, far better than we could have hoped a year ago. And long may that continue.
That's fantastic. It is interesting how well we have done. I remember around this time last year, Scott Morrison said he's going to build a bridge to get us to the other side. And we sort of thought that's a little bit interesting, but he got us there, and now they're continuing to support us. So overall, I'd give the budget and the government's handling of the pandemic economically, maybe not always health-wise, but economically, I'd give it a big tick. They've done a good job. I look forward to catching up with you once a month for these big picture economic podcasts. But if people want to catch up with you in between, because I know you have lots of data charts coming out on a regular basis, how can they best get the information from you, Pete?
There's a few places, but Pete Wargent Blogspot is my daily blog, and I think most of my contact details are on there, but I'm on the usual channels, Facebook and especially Twitter. I think it's going to be a good time for property. I think we talk about big picture. Well, record low mortgage rates, by my reckoning, that should push up property prices by between a quarter and a third over the next 3 years. So obviously there'll be variances within that, but I think it's going to be a bullish part of the cycle, and good news for property investors.
Well, you're also a diversified investor, and I know you know a lot about the share market, much more than me, and you've taught me a lot about it. And you've got a podcast specifically about that. So how do people find out about that? And tell us just a little bit about that, please, Pete.
Yeah, we do a stock market podcast. Low Rates, High Returns is the name of the podcast. You can find it on Apple or Spotify or pretty much everywhere else. So that's Pete Wargent and Stephen Moriarty, the Low Rates, High Returns podcast.
Sure. So I think it's important to have a look at more than just one asset class. Look forward to having a chat with you again in a month's time, Pete.
Always a pleasure. Thanks, Michael.
I hope you got some insights from my chat with Pete Wargent, but if you'd like to get a few more insights about property, success, money, go to podcastbonus.com.au, where you'll be able to find a heap of ebooks. I'll give you a bundle of ebooks and reports to give you more information. Podcastbonus.com.au. I'll leave a link in the show notes. Now, in a moment, I'm going to share with you my mindset moment where I suggest that you stand on the shoulder of others. And hey, it's not the game I play with my grandkids. I'll explain to you what it is in just a moment. But before I do, just to finish off my chat with Pete Wargent, we were saying how we really both believe there's still legs left in this property market. It's not too late. Yeah, it would have been better to buy 20 years ago. Of course, it would have been better to get in the property market 12 months ago. But there's still quite some runway in this particular cycle. But clearly not all markets, not all properties in certain markets, not all locations are going to perform as well as others. That's always been the case. So if you're confused with a lot of the mixed messages in the media and what to do and where to invest, why not have a chat with my team at Metropole? We'll love to give you some direction, some guidance and results. Whether you're a beginner or an experienced investor, we'll start by putting a plan together. It always starts with a strategic plan to help you plan to become the person you plan to become. It brings your future into the present so you can do something about it now. And then you may choose to use our buyer's agency, our wealth advisory, our financial planning, our property management services, renovations, development. It's up to you, but we provide a holistic approach to give you direction, guidance and certainty in this new economic era. So go to metropole.com.au, find out what we do, leave us your details, and we'd love to be part of your wealth creation journey.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I'd like to suggest that you find some shoulders to climb on. The inspiration for this chat I'm having with you now came from a blog I recently read from my good friend Tom Corley, my co-author of the book Rich Habits, Poor Habits. Now, in the 16th century, I remember reading about this guy in school, learning about this guy. In the 16th century, Galileo Galilei stood on the shoulder of the 15th century astronomer Nicholas Copernicus, when he proved that through his own experiments, what Copernicus has already found, but wasn't that well able to prove, that the sun was the centre of our solar system. Galileo stood on the shoulder of his mentors and proved he was right. Sir Isaac Newton, who many of us consider the father of physics and calculus, he stood on the shoulders of Copernicus and Galileo and René Descartes. Albert Einstein, he stood on the shoulders of Galileo, Copernicus, Newton, Descartes, and many others when he came up with his famous, mass equals energy formula. And that gave birth to the nuclear energy movement and to modern day understanding of what's going on in the universe. I guess the point I'm trying to make is that all successful individuals stand on the shoulders of others. Now, some of these shoulders that we climb on, they're not physical mentors that you've got, but they're books, they're podcasts, they're other ways of learning. But if you want to be successful, you need a mentor who's going to help guide you through life. If you want to be successful, you've got to know what to do and what not to do. And it's just too hard, too demoralizing to make the mistakes yourself. So ongoing growth in knowledge, success, not just in property, but in all areas of your life, is important, the foundation of your success. So let me ask you, whose shoulders are you going to climb on? Now, if you know the answer to that question already, that's great, because that means you're walking in the footsteps of those successful people who came before you. I hope you got some benefit from my chat with Pete Wargent, but if you want a bit more information about property, money, the economy, don't forget that group of ebooks and reports you can get by going to podcastbonus.com.au. Just leave us your details and we'll send you a bunch of ebooks. But if you got benefit from today's show and you know somebody else who'd get benefit understanding the big macroeconomic picture that Pete and I discussed, tell them about the Michael Yardney podcast, or you can tell the world by leaving a review, as Sohi8992 did on Apple Podcasts, and he wrote, "How can this be for free? I've read and heard podcasts of a few property experts, but none compare to this one. It's relevant to Australians, straight to the point, no fluff, and best of all, the experience Michael has in property puts weight behind his views and opinions." Boy, was this a lovely podcast review. Thank you so much, Sohi. he went on to say, highly recommended, been on this podcast for 2 months now, and I've even re-listened because each time there's a new connection or idea made. How's this for free? Well, he also wrote me a really nice personal email, and I did what I do for anyone whose podcast review I read out. I've sent him a copy of one of my books. So if you'd like to leave a review and then email michael@metropole.com.au, I'd love to do the same for you. If you'd like to catch up with me between these twice-weekly podcasts, just look for Michael Yardney anywhere on social media. And if you want some daily snippets, something exclusive that I don't give elsewhere, join the Property Update private Facebook group. Just go to Facebook and look for the Property Update group. Otherwise, I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?